Welcome, everyone. Let's get started. So the webinar today, we will try to take you through how to secure C-level buy-in for APS investments, because we do see regularly companies struggling with that. So how I think in supply chain, you typically see the impact, but your CFO or your CEO who need to provide the funding for improving supply chain planning, maybe a bit more distant. And we do see supply chain practitioners struggling with securing the buy-in or securing the funding for APS investments. It came up as a question during one of the latest webinars, so that's why we decided to zoom in on that topic today. As before, before we dig into content, we want to hear from you. So we have a couple of Mentimeter questions. Convincing arguments, that's clear. Challenge accepted. You can, at the end, we will have a Q&A. You can tell us whether you got convincing arguments and learned something new, yes or no. So what else? Why did you subscribe to the webinar? Inspiration to market supply chain planning to the leadership. Sometimes it's just business continuity and support growth. How to turn that into a business case. I think we will talk about the business case. What's in it for non-supply chain? Highly relevant topic in a cost-conscious business environment. What to take into account to have a decent ROI. Why my CFO is against my proposal. I've seen in the past that CFOs are against the proposal. So again, from our experience, we will try to share on how to get the CFO on board. Accelerate our change together with the executive level. Insights on how non-supply chain senior management does agree to open the wallet for something he doesn't see the need of. Excel is just fine. Yeah. To get trust in that kind of numbers. Good. So thank you. Gain more supply chain insights. Again, before we dig into content, it's also a bit based on what we see as a challenge in companies. So normally here you should be able to rank. If your CEO, CFO were to choose between 3 options, how would he or she prioritize? If all goes well, you can rank these. So there's always a limited CapEx available. And if there is a limit in CapEx available, how is your CEO or CFO prioritizing the CapEx and the investment? So I see that 15 people joined us on the Mentimeter, and many more have joined us on the webinar. So again, for people who are new to this, on your browser, you can go to menti.com or on your mobile phone. And if you enter this code 73537721, you should be able to participate in, I would say, our data gathering here. And so limited CapEx, I think that's part of the discussion. How does the CEO or CFO prioritize? Investing in additional production capacity, investing in a new ERP. I would say those two are equal here, but I would agree that investing in a new advanced planning system for supply chain is typically deprioritized. So it's a hurdle that we need to overcome. It's some kind of how it's perceived to be less important. If you look at these 3, which one do you believe is the larger investment? So we talked about production capacity, we talked about new ERP, we talked about an advanced supply chain system. Which one is the larger investment? So how do we prioritize? We say, well, we will first go for a new ERP or for new production capacity. And yeah, the new planning system was like a distant third. Question here is, which one is the larger investment? And we seem to agree that the new ERP by far is a larger investment. Additional production capacity probably depends a bit on your sector. Are you in an asset-intensive industry? What is it, more expanding packaging capacity, which might be a bit cheaper? But we seem to agree, at least in this group, that an advanced planning system is not necessarily the biggest investment. Instead, it's deprioritized. Third question, which one of these three has the most direct impact on improving service, cost, and cash? And so which one of the three has the most direct impact on improving service, cost, and cash? This is interesting. We see some competition between the advanced planning system and the additional production capacity. It probably depends. If your capacity today is really full, if you're heavily capacity constrained, then obviously adding extra capacity can have a major impact on service cost and cash. But let's put it like that. I've also seen CEOs with supply chain understanding who said, okay, I can add extra production capacity, but if I don't improve my planning processes, I will not put it to an efficient use. So maybe I can also get more out of the existing assets by improving my planning processes. So again, probably improving your planning will help you to get more out of the existing capacity. Adding extra capacity without improving your planning is maybe not the smartest way to move forward. But the consensus for sure here is that, it's not a new ERP who is going to have the most direct impact. And it's something that we see across companies. It's that I often say that the cost of a new ERP is easily a factor 10 of a new planning system. So if a new planning system would cost 1 million, depending on the size of your company, the new ERP might cost 10 million. And when it's about the business case or identifying benefits, it's probably the other way around. It's much easier to make the business case for a new planning system than it is to make the business case for a new ERP system. So in a certain sense, it should be obvious because there is a direct impact on service cost and cash. So it should be easy to make the business case, but some kind of how we don't get it explained to a CEO or a CFO because the investment in the APS gets deprioritized. I think that's where we see a lot of companies being stuck. So what is then the pushback? There's 2 Mentimeters left before we dig into the content. Let's say, these are things that we regularly encounter. And normally you can indicate here, like, do you recognize this? Is this one of the issues run into? People don't see the need to move to more advanced tools because they think it can be done with Excel, or they don't believe in the business case, or they don't see it as a priority, or they have a negative experience from the past. But what are you encountering? Give us some of your inputs and your votes. Okay, let's give us a couple more. Yeah, there's some extra votes coming in. It's interesting because we say, so I've certainly seen CFOs then typically who had a negative experience in the past and then they try to stay away from it. It seems that from the group here, on average, you say it's like, yeah, how do we convince them that we need more advanced tools and that we need something better than Excel? Then maybe, yeah, focusing more on the complexity in the business might help. Seeing it as a strategic priority. Sometimes in supply chain we are too flexible. We always fix the gaps, and that's maybe also undermining our own opportunity to then improve planning processes and improve planning tools. And I think for sure we will zoom in a bit more on that business case. Before we do that, last question here. Anything you want to add, like if you would have to say, okay, what's my challenge in convincing my CEO or CFO? It is that maybe we missed out on something. Maybe there's something different that you are running into, and then we'd obviously be happy to understand and capture that. So as this is coming in, CEO and CFO not aligned, that's even better. Okay, so this is a little bit the past experiences. Like if you screwed up, people have a long memory. If you did an investment even 5 years ago and it didn't work out as planned, yeah, people have very long memories. How are you going to make sure that it's going to be different this time? That's I think that's a hard one to overcome. So I suggest we now dig into the content, but I would say for sure they don't have a supply chain background. So I will come to that. So if we want to improve supply chain, it's better not to talk about supply chain, because as long as we talk about supply chain, they will consider it your problem, not their problem. And another one which we will for sure try to connect to is yeah, so when we say, yeah, but we're a sales-driven company and we're always investing in growth opportunities. So again, if we want to improve supply chain, sometimes instead of talking about supply chain, it might be good to talk about the business strategy and how we can connect to the business strategy. So moving forward, as I said, if you want to improve supply chain or supply chain planning, then don't talk about supply chain or supply chain planning, because then they will consider it your problem instead of their problem. And we should start with why. So why are we doing this? And I think that comes back to what you are then also saying, Nick. And if we then commit to why we are doing this, also how are we then going to follow up that we deliver the results that we promised? And people who've known us or who have been following us know that we are always working on based on the concept of what we call the supply chain triangle of service, cost, and cash. But what I want to briefly take you through is that, again, if we want the CEO and the CFO who don't have a supply chain background to understand what we try to realize, we need to talk their language instead of a technical supply chain language. And so service, cost, cash, I will make the language, I would say deliberately a bit more financial. So the cash, if we are a manufacturing company, from a planning perspective, we basically have an impact on the capital employed, which is the fixed assets. So better planning can help us to more efficiently utilize the fixed assets, the machines, and better planning can also help us to better manage the working capital. And working capital, 3 important components are receivables, inventory, and payables. And with planning, we directly impact inventories. And I would say the healthiness of our inventories. And inventory for sure is the most complex of the 3 components. Service, when I explain the triangle, I always need to say to supply chain people, Service is more than the on-time in full delivery performance, or service is more than the lead times that we offer. And service is also about how narrow or broad is the product portfolio, or service is also about, maybe we are a company which is driven by product quality, or we are a company that is driven by innovation. So the question then also becomes like, what is the innovations, the innovation rate, and how many innovations do we need to push through our supply chain? And so if we want to understand and define service, and again, if you want to know more, there's a lot more details in the books, and Rethinking Supply Chain is the latest book. If you want to define service, it's basically about defining the value proposition. How do we want to be successful as a company? Do we want to be more driven by price and play on price because we're in a commoditized market? Do I want to be driven by delivering a total solution, which might require a broader product portfolio combined with all kinds of services around that? Or do we want to be driven by product quality and a lot of innovation? That's really what the value proposition is about. And the value proposition, is basically driven by the strategy. And the first challenge for a lot of companies is to align that triangle really on a strategic level. Like, if this is what we want to achieve in the market, what level of cost is it going to drive? And what level of fixed assets or working capital do we need to deliver that strategic value proposition? And I would say you need to be aligned on the one hand on a strategic level, and second, you will need good planning tools to more or less continuously keep that balance in triangle. And I think we've explained before, driving service or driving value will lead to a certain volume and a certain price level. So here again, if I'm a price player, I may have big volumes, but at low prices or low margins. If I'm more a niche player, the volumes may be smaller, but it may be more expensive products or higher priced products and higher margin products. It's not only about the sales or the volume and the price, it's about the margin that we drive. Again, making it tangible for finance. What you see here on the right, the sales and the costs and the margins, that's the P&L. The bottom left corner of the triangle, the capital employed, is really about the balance sheet. So by improving planning, we will impact the P&L. By improving planning, we will impact the balance sheet. And we will need to make a business case for our investment. But here again, by planning, we really touch the heart of the triangle. So it should not be that difficult to see what is the impact on the sales, on the costs, and on the working capital, and translate that into a P&L impact and a balance sheet impact. Again, people who have been following us know that we link the optimization of the triangle to the optimization of a return metric, like the return on capital employed. So what's the EBIT you generate over the capital employed? Or stating it differently, like, how can I drive more EBIT or more EBITDA with less capital employed, with less fixed assets, or by better utilization of the existing assets and with less working capital, for instance, less inventory? And you can express that as a return metric. Some companies say, we prefer to use a metric like economic value add. What is that? So I have my EBIT here, and then I say, okay, let's assume that a certain business unit has 100 million of capital employed. If my weighted average cost of capital, my WACC, is 10%, I would say I account for the utilization of the capital employed, 10% of 100 million. So it's an extra 10 million that I will subtract from the EBIT. That's the economic value add. If this is complex to you, this is finance language. If you want to convince your CFO to invest, this is the language you will need to learn how to speak. There's more of it in the book, and obviously you can reach out to us. We can help you with defining that business case and translating it into financial value. There's other ways to drive or measure value. So we can look at a return metric or economic value add. We can also look at cash flow. So again, if I can drive more profit, and it's here measured now as the NOPAT, net operating profit after tax. Yeah, so it's the EBIT, and I subtract the taxes. I don't yet subtract the interest. Yeah, if I can drive more NOPAT, and I can do that with less capital employed. Yeah? So I'm selling off assets and I'm reducing my working capital. It has a positive impact on my cash flow, like the free cash flow. And these are really metrics to drive financial value. What we have added in our latest thinking is that it's not only about driving financial value. As companies are working on sustainability, we also need to drive that financial value within certain limitations. If I'm in procurement, it's not only about the cost and the quality of the product. I'm also concerned with, are my suppliers behaving in a socially responsible way? And all of our companies have targets on CO2. That's on our environmental ceiling. And those targets are getting more strict year on year. So it means that the ceiling is coming down and typically the foundation is coming up. So the freedom to operate that basic triangle we have here, that freedom is getting more and more limited or reduced. I think that's also one of the reasons that we need better planning tools and better planning processes. We call this our Solventure value generation canvas. So how do we drive value? This is how we drive value and how we measure value. And where does APS have an impact? Well, advanced planning systems, on the one hand, need to allow you to better balance that triangle. So deliver the service, the cost, and the cash, and improve on the 3 dimensions at the same time. And if we have time, I also want to briefly touch upon strategy. So if you want to connect to finance, this could be a good framework to connect to finance. If you say, we always invest in strategy or in innovation, again, by clarifying how do we want to compete in the market, and then explaining, but if that's what we want to achieve, we will also need to invest in good supply chain planning capabilities to support that strategic positioning in the market. Those are the ways that we typically try to connect to non-supply chain folks. Happy to hand over to you here, Nick.
So one of the key aspects over the past years has been like, okay, how do we drive the value identification in projects? And actually, we have for many years, for past 15 years, always collaborated with clients on defining a business case. And later on, we will also introduce our business case template that we have used for that. And we know all of the factors. It's like inventory, like working cap that influences working capital is one of the routes to quantify a return as part of a business case. But actually, it's our sales team that, through the feedback we've gotten over the years from our prospects and customers, that has said, like, okay, we need to strengthen that approach if you want to better guarantee the delivery upon a strong business case. We need to actually strengthen our approach, and that's what has led us to redefine our commitment towards doing projects. And I would state that there is like a step that we have included before and a step that we include during the implementation and delivery of a planning process improvement. The step before is the value identification, where we do a performance assessment, where we actually analyze data from the organization. As Bram indicated, we start from that value generation canvas, which is quite financial. It includes a lot of financial and commercial data, together with that operational data that we'll do at the beginning of engagements with customers. that assessment will actually lead to where are the performance improvement, where is that performance improvement potential, and that will be included in a business case. So it's assessing the current state of the organization based upon data in depth before actually engaging on the design of new planning processes and implementation of systems. And during the implementation, we will actually follow up on the key KPIs that are part of that business case and see that the envisioned trend, the envisioned evolution is also getting into reality during the implementation and shortly thereafter in the sustain phase after the implementation and go live of a planning, an improved planning process. So that's kind of that end-to-end cooperative approach that we envision and have put in place together with customers. So some examples on that, Bram, are on the next slide. So this is an analysis of a current portfolio of some of our clients. And actually, I just included this to not talk too much about segmentation of the portfolio, but merely to talk about, okay, in order to do that value identification, we need to include sales revenues, sales margins, volumes, and also inventory. So and look at these different components. And I still remember a couple of years ago when I did some research with existing customers, I saw supply chain teams that were unfamiliar with the profitability or margin that was generated within the portfolio of products. So, and that is not a good starting position. If you need to convince your executive team on the delivery of a business case, you need to be able to talk not only supply chain language, but you need to be able to talk also that financial language that also Bram brought into the picture. So revenues, margin, and linking it to more operational aspects, or what is considered by a broader organization, operational aspects like the performance of inventory, and linking it to that for that component of working capital. I've included in the next two slides two examples. We'll start with one example that actually starts not from a classical forecast accuracy improvement storyline, but actually starts from, okay, we need to target an OEE improvement, because if we find an OEE improvement, we can actually improve our profitability, improve our cost of goods sold, actually. And then the data that is being analyzed is quite operational. So it's analyzing by resource, what are the different routine stoppages, classifying that in the type of stoppages, then expressing like, okay, what is currently the amount of time spent in setups. Here in this example, if you look to the right side, you see their setup, which accounts for 16% of the total time. So 16% is quite significant. And that's also an area which you can target. This is very data driven. You target, okay, 16% of time that is spent on setups. So here it's the point where either companies can decide to build additional assets, additional production capacity, or they can optimize the utilization of the already existing assets by investing in better planning and better organization. And from this reduction of setup times, you can calculate it through towards a business case. Bram, if you click once, then you see actually one scenario where you actually translate the reduction of setup time. Here you have an as-is of 16% routine stoppages due to setups, and you bring it to 10%. You target what would it bring us if we reduce it to 10% only, which you could consider as a sort of industry best practice to be around that 10%. Okay, what would it bring us if we then also reduce the direct labor proportionally? What would then be the result? This is now for one of the facilities, not a very large facility, but okay, it would give us a certain return of a margin increase of around 800,000 euros, or 1% of setup reduction gives us 120% of savings. A different scenario is where you say, okay, we're not necessarily in cost savings mode. And if Bram clicks once more, then we get actually a scenario where the freed up capacity is being utilized by additional volume. We attract additional volume either by growing into the market space or by consolidating volumes from other facilities or other locations in the network. And it's a rationalization possibly of the footprint we have. Then actually we don't need to kind of proportionally reduce the labor costs, but we can actually state, okay, what is the additional material margin that we generate from being able to produce more on those existing assets. And you see that that scenario is also much more beneficial, let's say, when you can actually better use those assets to generate more output. That's where it gets quickly very interesting. And the last step is what we included also in that case. When you extrapolate that from one facility to multiple facilities in the network, and Bram can click once more, then you will actually see, okay, for a European scope, you could target a setup time reduction of 1%, 2, 3, 4, and you see actually what is the result of these improvements. Of course, in order to realize such significant setup time improvement, you will need to have a better planning process and planning mechanisms. But I would state, if you would have such a starting point to improve planning processes and planning systems, then you're well equipped because you have created a very good baseline and you have tangible targeted benefits that you envision at a later stage. So this is an example from better utilization of assets, let's say. The second example is from a different dimension. It's much more focused on inventory reduction. So working capital improvement. And here we focus on two aspects. One is targeting what are actually goods that we keep on inventory but are sold to only single customers. The total inventory here in this case is 2.4 million, and we actually have 460,000 euros of inventory that is sold to one single customer. So you could question yourself, like, okay, what is the role of this inventory? Because actually it should be a make-to-order good. So it should be better managed and better planned for, that we don't keep this on stock, but actually we immediately ship this towards the concerned customers once it is being produced. And the second element here is products where the inventory efficiency is very low. And the return that we have on the investment in inventory, the gross margin return on inventory, is lower than 2, which is very low. And so you only get your investment in the inventory back twice a year. Well, if you target that area of the inventory, you get an additional 570,000 euros. You subtract the overlap between the two groups, and you target around 760,000 euros inventory reduction. So which is, in this case, it was around 31% of the inventory that can be rationalized, can be reviewed. And here the risk on the profit side was only 1%. And so we risked 1% by changing both the business model as well as the planning strategy for these items. So that's a different way to build a working capital kind of business case. What are the benefits we are after? Of course, there is a classical safety stock analysis that can also be made, but this is kind of a different angle towards targeting what is a working capital reduction potential. So these are two examples of that value identification.
We intimately believe that there's a lot of value you can drive through better planning. We can help you to identify where that value is, and we're also happy to take a commitment together with you to drive that value and deliver that value. That also obliges us to go after that value together, realize it, and avoid situations like we didn't realize the business case, so then people no longer believe in the concept. Yeah. if you don't deliver the benefits. It's indeed, it's fair, I would say, from CFOs to then doubt why it would work this time if it didn't work out last time. Next to the more quantitative stuff, just some other things we can do is like, before you go into the numbers, we've also used the triangle just to do more a kind of a brainstorm with an executive team. We explain what the triangle is. We hand out post-its and we ask people like, where do we see issues? When we do that, the triangle is always full of issues. And then we ask the question like, is this an issue that we should solve, yes or no? So again, if you want to improve planning, don't start from planning. You can start from quantifying where the financial impact could be. You can start from this kind of brainstorm. We do have a ROI template we have available, and that can also support you in capturing the business case. All of that is available. Given the time, there's one other small connection I want to make. I said, so you can start from the triangle and use the triangle to identify financial benefits. What we've also done in the past is try to link planning to a strategy and enabling strategies. And again, there's more on that, a lot more on that in the books. And if you look at strategy, and what strategy is about, well, strategy is about making choices, and everybody will have seen this meme somewhere. And I often say if strategy is about making choices, companies are not necessarily very good at strategy, because companies are led by humans, and as humans we hate to make choices. We think choosing is losing, and strategy literature says no, choosing is not about losing. Choosing is about creating focus, and more focused companies are simply more successful. So we also have tools available where we can help you to reveal your strategy, your strategic position. And it starts with selecting 3 out of 24 statements. And then we can reveal your strategic profile, and we can also reveal how aligned you are within the executive team. You don't want to be in a position where R&D thinks you're a product leader, and manufacturing thinks you're operational excellence, and sales thinks you are customer intimacy. That's not how strategy works. You really need to be aligned also across the different members within your executive team on what your chosen strategy is. And maybe you say, okay, I want to be a total solution player, and so I will have a broad assortment and I will wrap a lot of services around that. Again, if I need to manage a broad assortment of products and people expect all of that to be available immediately out of stock, if I want to do that with reasonable inventory levels and reasonable cost levels, I will need to invest in good planning systems. And so we can also try to, and commercial people love these type of exercises. Also CFOs love this type of exercises, but it's another possible way to connect and say, hey, but if that's what we want to achieve in the market, if that's our value proposition, we will need good planning processes to support exactly that. This is an example of a product leader where we say we're not driven by assortments here, we're driven by product quality. And product quality also comes with a lot of innovation. So maybe we need to be able to scale fast or fail fast. That also requires a supply chain which is sufficiently responsive. Here again, we need to have S&OP processes and planning tools who help us to either scale fast or fail fast. And you could also be in this type of situation where the strategy is obviously not clear. Well, if the strategy is not clear, it's impossible to design the corresponding supply chain or support it with proper planning. And then obviously, if this is your starting point, we can help you to first in the executive team clarify the strategic positioning and say, hey, but who do we want to be again? And once we know who we want to be in the market, we will need to make sure that we design the right supply chain and the right planning processes to deliver exactly that. And so just to remember, like, I mean, how do we get the buy-in from non-supply chain people? Yeah, don't talk supply chain languages. So talk business language or financial language. That's the triangle in the business case. Or try to talk strategic language. That's what we are trying to do here. If you want to know more, obviously reach out to us. And there's also a lot of it described in our books. And then a couple of cases before we dig into questions. So yeah, a recent customer, I would say, What's Cooking, the formerly known as Ter Beke. What was the situation there? I would say that Ter Beke was had a landscape which was primarily based on Infor, Infor N3, Infor advanced planning, Infor advanced scheduling, and I would say it more or less had evolved into a legacy landscape where they were lacking sufficient knowledge and sufficient support on how the models were working and how to make these models evolve. And if you're in that kind of situation, you see that all kind of Excel files pop up. So next to the core of Infor, there were probably 100 Excel files, which were being used to drive the actual planning. And okay, so planning transformation, selecting a new system. How was the business case made? I would say what's maybe specific to mention here is that Ter Beke said, or What's Cooking, like, we expect service improvement, and service improvement should help us to drive extra sales. You don't always get that sold. In this case, Jeroen, who was the sponsor at the time, and the supply chain director did get it sold to the executive team, because obviously, if by improving service you can convince people that you will grow sales, for sure that always has the biggest impact or the biggest leverage. Next to some reductions in transport costs or inventory write-offs, a typical question is also like, will we be able to reduce the number of FTE? I see different of approaches. Here the approach was, we're not going to reduce the number of people. Those people will do different tasks. Instead of collecting data into Excel files, they will basically help us to make better and more proactive planning decisions. I've seen other customers where also a reduction of the number of FTE in planning is part of the business case. If you want to know more on this case, there's a QR code you can scan with more details. Nick.
One of our other customers is Poppies. It's a customer that we have worked for the past 12 or 13 years. So we have supported them along different phases of their evolution as a company. They're quite large player in private label manufacturing of sweet bakery products. They're not very known, let's say, in the market space or in the consumer, let's say, and user market space because of that position as private labels player, but they're quite sizable. They do a very sizable amount of revenue, I think around 400-500 million euros in turnover, which is quite impressive growth trajectory that they have gone through. When we initially started working for them, they were very decentralized, and they grew through acquisitions, and actually on the acquisitions, mostly the sales and the sales operations was centralized, but all of the other functions were kept quite decentral. So sales and finance was central for all of these entities, but furthermore, supply chain logistics was considered very decentral activities. And one of the first collaborations we have done with them is to centralize their demand planning operations into a central, to bring that to a central role. And there it was very instrumental to actually do demand planning, not only for supply chain, but actually do demand planning for also a baseline for financial planning. So we actually worked and supported with them on, okay, how can a good bottoms up forecast actually be a strong foundation for a quick gross margin projection for the next year, which is often a very key component of their financial plan. A second iteration, we have worked with them then on inventory and supply, but a second big wave in the collaboration with Poppies has been their transition to S/4HANA, which actually has been an initiative to redesign a lot of their processes and rethink a lot of their processes, where they also have made a clear choice to actually make very strong supply chain processes and centralize those as well. So that has been a new initiative, and actually that supply chain, so that APS investment has been also very beneficial for that larger ERP program to deliver upon their business case. So that's also a good moment if there is an ERP trajectory to actually also use that envelope, use that momentum to actually help deliver that overall business case. Typically, that's also one of the moments to engage.
And I think that ties nicely into that hero case where I think we had been in discussion with the hero for some time on improving S&OP, improving planning processes, and in a certain sense it was hard to get that positioned and to get that sold. And I think the big difference or the accelerator was also an S4 migration where Hero was moving from different sub ECC systems into one S4HANA system. And they said, we don't want to wait for the new S4 to start harmonizing our planning and integrating our planning. And they made a business case, I would say, for the joint APS ERP project. As you know, an ERP costs a lot more than an APS. And what was interesting about the Hero case is that the business case for the total S4 plus APS transformation, most of the benefits, roughly speaking, around 70 to 80%, was coming from the APS implementation, because it was the APS which was like adding the intelligence on top of the ERP system. So indeed, so when you move into a new ERP platform and you are already spending a lot of money, I would say don't wait for the APS, but try to tag on the APS. It might make the APS an easier sell. And okay, I would say don't even hesitate to then say the business case of the total transformation. Most of the benefits are going to come from that APS system. That's, I think, something special about the Hero case. A last thing maybe to mention about that Hero case, that this is an example where we as an implementation partner, there was like a bonus malus system. On the one hand, we could go in the minus, and going in the minus was based on project criteria like, are we on time, are we on budget, and are we delivering the functionality that we promised. And we can also go in the plus if we deliver the anticipated business benefits. And doing these implementations now for 20 years, I think we came to understand that these are complex transformations because they are very data intensive. You typically need to do a lot of process standardization and harmonization. You need to learn people how to work in a different way with more advanced and systems with more advanced functionality. So it is quite complex to do those transformations. So I think there's a lot of failed implementations. And again, people have long memories. So if your CEO or CFO has had bad experiences in the past, that might also make them reluctant to try it again and say, why would it be different this time? Well, the only thing I can say is that we are willing to look at how to, and we are willing to look together with you on where the benefits are. And we are willing to make a commitment together with you on delivering success and delivering the benefits. And if you ask me, more implementation partners should be doing exactly the same. Good, let's, I think that's what we had foreseen. We're happy to take a couple of questions. So if all goes well, somewhere in the webinar bar or screen, you should be able to ask questions, and we will normally see them popping up here in the question box. There is one question already here from Prismek, if I pronounce that correctly, like how to measure if we are fit for APS. I would say that's a good question. Like also there we have tools like a maturity assessment, and we can help you to understand your current maturity. I think an APS always delivers benefits. The question is, what's a good roadmap and where do we start? And that may depend on the one hand on your current maturity in your organization, the maturity of the people, the maturity of the processes. It can also heavily depend on the quality of your data. Also there we have a lot of experience in doing data quality scans and help you to identify how good your data currently is before you make APS plans or embark on an APS journey. But those are typically a couple of things that we would check.
Maybe to add there, Bram, also one aspect is the size of the organization and the size and the best solution then to engage, and the best solution and the best vendor to engage with on your APS journey. So typically what we have learned over the years is that different APS solutions that exist in the marketplace, that some of them are a better fit for certain industries, but also are a better fit for a certain type and size of company. So depending upon which size of organization you currently are, it's also an important consideration to actually choose or select a solution that fits where you are in your growth journey as a company. And sometimes it might be a more pre-configured solution or be a more enterprise-grade configurable solution. And that is definitely also one of the dimensions I would include.
Maybe you want to take the next question, Nick?
What steps are there to assess the working capital optimization and how to link this to the contribution of the APS? Working capital optimization typically triggers with me to do an inventory scan. The large, as Bram said, like the most complex part of working capital is the inventory piece. That's the most complex. Accounts receivables and accounts payables is typically more easy to investigate, but the inventory is the most complex to model and to link also to the footprint of the supply chain. So what we have done for many years is to do an inventory scan. What is your current inventory performance? So we start with month-end snapshots for the past 12 to 24 months. Understand your physical supply chain, model that, and compare your actual performance with what you should have based upon what is your service level target. So that's definitely one of the approaches that can be taken, and from that it gives a quantified approach to, okay, what is then the inventory reduction potential, and that should or could be then definitely a part of your business case. And it seems like very classical, but we have seen a lot of cases where it's not done properly, where it's then done like currently it's 60 days of inventory. We want to go to 50 days, just minus 10 days. And if you then ask how do you get to minus 10 days, so that looked like a fine number. So that would not be my suggested approach there. I don't know, Bram, if you want to add something on that.
No, and how to link this to the contribution of the APS. That's so when we commit to certain targets, that's a pushback I even get from consultants, and they say, Bram, but we are committing to improving forecast accuracy. But what if all of a sudden there is a crisis in the market and that is negatively influencing the forecast accuracy? And what I say to people is like, yeah, there will always be external influences which are influencing your supply chain parameters, whether it's inventory turns or forecast accuracy. But if we don't measure it and if we don't put targets in place, for sure we're not going to drive the improvement. And I do ask customers, and I say, okay, if we have this in our targets, so to speak, please put the same targets in the incentives of your people. And regardless on what is then linked to APS and what is not, if on both sides we have targets to drive certain improvements, if things are not going into the right direction, at least on both sides, we will have some signals going off. And if on both sides intelligent people are looking on why certain parameters are not going into the right direction and start taking action to drive the improvement, I'm quite sure that we will drive improvements into the right direction. And instead of focusing too long on how do we prove it's linked to the APS, I would say no, let's focus on how we are going to drive business results. And for sure, APS is going to contribute to that. And so it's only half an answer, but I think it's our current perspective. And maybe a last question before we then close the webinar is like, are you using DDMRP? I would say yes. Again, it depends a bit on the tools we are using. Some tools have it as a native capability, some have not. There's a whole discussion we can have on when to use DDMRP and when not to use it. If you ask my opinion, the DDMRP movement is sometimes a bit religious in the sense that they say it's a one size fits all and it always works. I think it works well if you are in a relatively stable market or if your current maturity is extremely low. That also means that as soon as you already have some level of maturity or you are in markets which are a bit more volatile, I'm not necessarily convinced that it's the best approach, but we probably need a separate discussion and separate webinar to discuss that into more detail. So I would say in general, we try to be aware of what different types of planning approaches are available, and together with the customer, we try to think through what type of system or what type of planning approach is best fit for the situation we have at hand. And I would say increasingly we become more output driven and value driven. So I'm increasingly less concerned on, I would almost say, on how we drive the benefits. We are increasingly more concerned about identifying where the possible benefits are, and together with our customers delivering the benefits. Because again, if the question here is, how do I convince a non-supply chain person? They don't understand the DDMRP, so they would probably be less concerned on how we drive it. I think they are more concerned with what type of results we drive. And that could be financial results, or that could be strategic results, that we say, okay, if this is where the market is going, if this is what we need to deliver. I have another discussion last week with a potential customer who says, today it's more contract manufacturing, but tomorrow we need to start delivering private label products to retail. Today they have orders in 1 month ahead, and then they have a committed forecast for the 2 months after that. Their complete business model is going to change, because if you deliver private label into retail, they order today and you have to deliver today or tomorrow, and you will not get any forecast. So they will need to pull together a forecasting and planning capability that they don't have today. Well, again, it's more coupling to the business challenges and the business strategy. So I think those are at least the two perspectives that we try to bring into that webinar today. And with that, I think we are more than filling our time. So I would say thank you all to be here today, and hope to see you at a next occasion.